Going live. Yo.
Here we are. Pass me a book.
Here.
Today we're going to be reading from Bitcoin 1 Million, this best-selling book that we wrote.
Yep.
I got to tell you, I was in Tahoe this weekend with a bunch of guys, and I was showing them the book, and they were loving Bitcoin 1 Million. They're loving Bitcoin. So it's pretty exciting, honestly. I think this book's going to really convince a lot of people to check out Bitcoin more seriously.
So you were in Tahoe. Did they people like the book?
They loved the book, and they all wanted a copy of the book.
Yeah.
And it was awesome. So, yeah, it's really cool.
Okay, let's read.
So basically, we're going to be reading chapter 10. Yeah.
Chapter 10, Bitbonds. All right, go ahead.
Bitbonds. This chapter introduces the financial innovation that could accelerate Bitcoin to $1 million. Bitbonds. You'll learn how governments slash borrowing costs while giving investors Bitcoin upside, while the Giscard bond disaster of 1973 proves you should never short hard assets, and how the Bitcoin Policy Institute's proposal could transform the 130 trillion bond market. This speculative but plausible innovation could trigger massive institutional adoption. So, a financial innovation. In 1983, Larry Fink and his team at First Boston created the Collateralized Mortgaged Obligation, CMO. And within a decade, this simple idea, repackaging volatile mortgage payments into predictable cash flows, grew from zero to over $1 trillion. It changed how Americans bought homes and how institutions invested. Today, we stand at a similar inflection point with Bitcoin. The challenge is the same. How do you transform a volatile, unpredictable asset into a stable, predictable cash flow that conservative investors can hold? How can you give investors a kicker if Bitcoin outperforms, as we think it will, and at the same time lower the interest cost for the issuer? The answer might be Bitbonds. Speculative, but potentially transformative.
All right, so what are Bitbonds? Bitbonds are hypothetical fixed income instruments that combine traditional bond features with Bitcoin upside participation. Think of them as regular government bonds with a Bitcoin lottery ticket attached. In March 2025, Andrew Hones and Matthew Pines of the Bitcoin Policy Institute proposed government-issued Bitbonds, which they call Bitcoin Enhanced Treasury Bonds, as a way for the United States to build Bitcoin reserves while reducing borrowing costs. Here's exactly how they would work. The U.S. government announces a new 10-year Bitbond with specific terms that revolutionize government financing. The bond carries a face value of $1,000 with an annual coupon lower than regular treasuries, say 1% versus 4.5%. The key innovation, participation in Bitcoin price appreciation. When you pay $1,000 today, you're buying both safety and upside. According to the Bitcoin Policy Institute proposal, the Treasury splits your $1,000 strategically. 90%, $900, goes to regular government bond funding operations, maintaining fixed traditional fiscal operations. The remaining 10%, $100 out of the $1,000, purchase Bitcoin for the strategic reserve. This Bitcoin purchase backs the upside participation promise and ensures the government benefits from depreciation. Both investor and issuer align their interests through Bitcoin exposure. Now, this is a diagram that sort of shows you the Bitcoin Bitbonds proposal. And what you can see is you have these reduced payments of 1% for the first 9 years. And then I think this was a 5-year Bitbond, but it'd be 10 years of very reduced Bitcoin payouts. And then you have a final payout in the end. And the final payout contains a Bitcoin kicker, right? But in any case, you're always going to get the equivalent yield as if you just invested in a straight bond. So it's basically only upside. You get 4.5% guaranteed, but if you...
Is that paid out every year, or is that paid out at the end?
Everything's paid out at the end.
Right.
Right. And so but if the kicker ends up being higher, if Bitcoin ends up being higher, you get even more. So
Now, one thing I want to just interject here is that we got a message from one of our readers saying that there was a lot of percentages in this chapter. So just to clarify one thing, this is a very hypothetical situation, but what we're talking about here is that out of the money, the principal that's being kicked in, 10% of it goes to buying Bitcoin in this example.
Yeah.
But later on, the amount of the gain in Bitcoin is shared 50%.
Correct.
So there's two percentages that matter in this. This is an example. The percentages could change.
And this is completely hypothetical. The U.S. government has not issued this bond and may never issue this bond, but we think it's a very interesting thing.
Right.
Okay, so
scenario.
No, before that. Every year for 10 years, you receive 10% in interest payments, 1% of 1 million, 1,000. This happens regardless of what Bitcoins or stocks do. It's guaranteed income, just like a regular treasury bond, providing steady cash flow while you wait for your potential Bitcoin appreciation. After 10 years, the government calculates your final payment. You're guaranteed your $1,000 principal back, plus you've collected $100 in coupons over a decade. If Bitcoin outperforms the 4.5% annual threshold, you get a bonus payment based on Bitcoin's appreciation. So let's consider two scenarios on a $1,000 investment with 50% Bitcoin participation.
That's the second part. So it's 50% Bitcoin participation. So there's sort of two different things. There's the allocation and the participation.
Yep. So go ahead.
Scenario one, Bitcoin goes up 10x. That's a 900% gain. Your bonus equals 50% of the 900% gain, or 450% of your investment. That's $4,500. Combined with your $1,000 principal return, you walk away with $5,500 on your original $1,000 investment. Not bad for a safe government bond. Scenario two, Bitcoin crashes 50%. No bonus payment triggers, but you're still protected. You receive your $1,000, the principal, plus the equivalent of 4.5% compounded annually, which is $533, for a total payout of $1,553. You match what a standard treasury would have paid. The cash just arrives at maturity rather than annually. So you can't lose versus a regular treasury bond. The Bitcoin participation only adds upside, never downside for you. In the worst case, you get the same return as a standard 4.5% treasury, though the cash flows are delayed until maturity rather than paid annually. The incentives for governments to issue Bitbonds are compelling. The BPI proposal, Bitcoin Policy Institute, suggests issuing $2 trillion in Bitbonds, about 20% of the 2025 refinancing needs. At current 4.5% treasury rates, this could save $70 billion annually in interest costs. The strategic advantage, 10% of proceeds, around $200 billion, would go directly into building a strategic Bitcoin reserve. This provides the core benefit. Bitbonds provide political cover for Bitcoin accumulation while ensuring the government is long, not short Bitcoin. And the first major economy to issue Bitbonds would attract massive international capital. Foreign central banks, sovereign wealth funds, and institutional investors seeking Bitcoin exposure without direct holdings would flock to these instruments. Plus, the market would go crazy.
All right, so let's talk about the Z-Star bond, a cautionary tale. Before we get too excited about Bitbonds, we need to examine history's most spectacular commodity-linked bond failure. In 1973, French finance minister, later president, Valéry Giscard d'Estaing, issued a revolutionary bond indexed to the price of gold. The French government, seeking to restore confidence and amid rampant inflation, promised bondholders that both the principal and interest would adjust with gold prices. The structure seemed brilliant. Gold was trading at $100 per ounce when the bonds were issued with a 7% coupon. Investors would be protected from inflation while France could borrow at attractive rates. The bonds were wildly popular, oversubscribed within hours. Then reality hit. Gold exploded from $100 to $850 by 1980. The French government's liability increased by 850%. A bond that should have cost France perhaps 150% of principal to repay suddenly cost 850%. By 1978, the French government found itself obligated to pay out 40% of the bond issue value in a single year's interest alone. A little bit of a problem. The government faced a choice: default or financial ruin. France chose a third option: forced conversion. Before gold peaked, the government defaulted by forcing bondholders to convert to regular bonds at unfavorable terms. Investors who thought they'd found the perfect inflation hedge instead learned that governments won't honor contracts that threaten their survival. The Giscard bond disaster teaches the lesson: never short a hard asset. France went short gold without owning any. When gold rallied, they had no collateral to meet their obligations. They were naked short in the most catastrophic way possible. Bitbonds avoid this fatal flaw through a crucial innovation. The issuer must actually own Bitcoin to collateralize the principal. When you issue a Bitbond with 20% Bitcoin participation, you need to buy Bitcoin to hedge your exposure. This creates a virtuous cycle where issuing Bitbonds requires buying Bitcoin, making price appreciation beneficial for both the issuer and the bondholder. Unlike the Giscard disaster, the issuer becomes long Bitcoin rather than short, measuring success, meaning success strengthens rather than destroys the issuer's balance sheet. France's mistake wasn't just indexing to gold. It was promising gold exposure without owning gold. They created unlimited liability with no assets to back it. Modern Bitbonds flip this completely. The issuer accumulates Bitcoin reserves, making a truly desirable, making a rally desirable rather than devastating.
Mm-hmm. Yeah, I think just one thing I want to comment on is that now we kind of switched to 20% participation here, or just these are just for examples, right?
We don't know. I mean,
we
it
don't
could
know
be
what's
5
gonna
year,
be.
it could be 10 year. So it's a very simple. It's just a general concept here, which is you have a bond that pays out, that is going to issue some percentage.
It's going to allocate some percent.
It's going to allocate some percentage of the proceeds to buy this Bitcoin, and it's going to give some percent of the Bitcoin appreciation as a bonus
at the end.
At the end. That's it. There's nothing else that's hardwired in this. All right, let's go to the tips precedent.
The tips precedent. So learning from the Giscard disaster, when Treasury inflation protected securities, TIPS, TIPS, launched in 1997 with a mere $7 billion issuance, they used a much more conservative structure, adjusting principal only for CPI inflation, not commodity prices. So Wall Street initially yawned, but today, TIPS represent 1.7 trillion in outstanding securities, essential portfolio components for every institution. Fixed income innovations follow.
I just want to put a little footnote here. TIPS are some of the favorite investments of my friend Victor Hagani of Elm Street Partners. You should read this book, The Accidental Billionaires. Not Accidental Billionaires. The Missing Billionaires by Elm Street Partner, ex-Solomon Brothers, and one of the principals of LTCM. Okay.
Right. So
fixed income
innovations follow a predictable pattern. Initial skepticism, tentative experimentation, explosive growth, then universal adoption. But success requires learning from past failures. Bitbonds could compress this timeline from decades to years if they avoid the Giscard trap. Giscard trap. While government Bitbonds remain theoretical, corporations are already moving in this direction. Strategy, MSTRs, preferred shares, STRC, are proto-Bitbonds, debt-like instruments that provide indirect Bitcoin exposure.
I would say more STRK.
More STRK.
Right, but yeah.
But still. We almost cut this chapter out. It's really a great chapter, actually. But at first we were like, this is very speculative, but it's actually really, really interesting. The next evolution is obvious. Strategy could issue true Bitbonds with explicit Bitcoin participation, moving beyond their current convertible structure. Tech giants like Apple could issue Bitbonds to attract new investors while reducing borrowing costs, tapping into the massive demand for Bitcoin exposure. Banks could create Bitbonds to fund Bitcoin trading operations during client demand into funding opportunities. So Bitbonds could solve pension funds' Bitcoin dilemma. These funds manage $35 trillion globally, but face constraints that make direct Bitcoin investment impossible. Fiduciary duty restrictions prevent speculative investments, while volatility limits exclude assets more than 20% annual volatility, which works upside and downside, right?
Yeah.
So career risk looms large. No CIO wants to be the first into Bitcoin, and regulatory restrictions on speculative investments create all these barriers. Bitbonds solve all these problems. They're bonds, not Bitcoin. They have predictable cash flows. They come from rated issuers. A modest 2% allocation from global pension funds is $700 billion, a massive influx that could drive significant price appreciation. Now, one of us, Fred, spent years at Solomon Brothers during the golden age of fixed income innovation. They created instruments that seem obvious now, but were revolutionary then. Dual currency bonds, synthetic formulas, complex derivatives that matched specific risk profiles. The lessons from that era apply directly to Bitbonds. Complex risks can be repackaged into simple products that institutional investors understand. There's always demand for principal protection combined with upside potential. It's the holy grail of fixed income.
So everybody wants a fixed income and
With
give me a
upside.
little upside.
Yeah.
They love that.
So financial engineering creates genuine value by matching different risk profiles and preferences. Most importantly, the first mover advantage in new structures is enormous, allowing pioneers to capture premium pricing and set market standards. Tom Wolfe captured the intoxicating atmosphere perfectly in Bonfire Vanities. Young traders creating instruments worth billions, transforming staid bond markets into engines of innovation. Bitbonds represent the next chapter in that
So
story.
just to be clear, in that story, they reference the Giscard bond, and they hear the protagonist of the Bonfire of the Vanity is a trader. And actually, Tom Wolfe went to the trading floor at Solomon Brothers to research this, what it was like, and he created a very accurate portrayal of the Solomon Brothers trader in the 80s.
Right. So once basic Bitbonds exist, financial engineers will create endless variations. Principal protected notes will offer 100% guarantees with 50% Bitcoin upside for conservative investors. Leveraged Bitbonds will provide 2 or 3x Bitcoin participation for aggressive investors seeking amplified exposure. Zero coupon Bitbonds will deliver all returns at maturity in tax-efficient structures that defer income recognition. This proliferation isn't just speculation, it's the natural evolution of successful financial products. Every asset class that achieves critical mass spawns hundreds of variations. So Bitbonds needs supporting infrastructure to reach institutional scale. Pricing models must incorporate Bitcoin's unique volatility patterns, which are different from traditional assets. Deep derivatives markets for hedging become essential as issuance volume grows. And institutional custody solutions need standardization across counterparties. Credit rating methodologies must also evolve to access Bitcoin-linked obligations properly. So based on historical precedents, Bitbonds could follow this trajectory, 2025 to 2026. First, corporate experiments, 10 to 50 billion. Strategy or similar companies, or a similar company leads with premium pricing due to novelty.
So look, here's an example.
Yeah.
Okay, Strategy could issue a $1 billion Bitbond right now, right? It's just, by the way, just today, Strategy got rated B-.
Wow.
Okay, first rating of a Bitcoin treasury company. So it is now rating. Okay,
Wow,
it's
that's
rated.
amazing.
So now they issue a bond, a Bitbond. Okay, they say we're going to issue a $1 billion Bitbond at let's say the Bitbond's at 1%. Okay, just like in the example, and it'll be issued at 1%, and let's say it's a 5-year bond, and it has a designated yield of 9%, right? And you receive 1% a year, and you are guaranteed 9%. Okay, guaranteed. But in addition, if Bitcoin completely appreciates, you're going to get a little kicker on top of it. Now, everybody would want that bond, right? Because it's a fixed bond. You are going to get paid out at a certain date. It's not like the STRC or the STRF or any of these things, right? Which have no maturity. Those are perpetual prefers. We're talking here a fixed redemption date.
Now,
That's the beauty of
answer
Bitbonds.
one thing to me about this Bitbond.
Okay.
At the end of that, to pay the kicker, do they have to sell Bitcoin?
Yes.
They have to sell the Bitcoin.
Of course. Or they have to pay the kicker, whatever way they can issue more bond.
Right. So
They
they
can
don't have
issue-
to sell the Bitcoin.
They
I
don't
think
have to.
It's
but-
important to understand.
But what they have to do is
They have optionality, though. They could sell the Bitcoin.
they could sell the Bitcoin, but what they're doing by issuing Bitbonds is they're issuing money. In the case of strategy, they buy 100% of the Bitcoin, right? But they're building this structure from the investor point of view. You're getting your money out at a fixed maturity. So I'm giving strategy my money for 5 years. I'm like, it's rated B minus. It's a great bond. Okay.
Is B minus a high enough rating for pension funds to
Yeah.
invest in?
It's okay. It's not
Not all pension funds, but that's not.
it's okay. It's not junk, right? It's not really toxic debt, right? So it's rated. It's rated. Look, I mean, some of these companies couldn't get that. I mean, Nakamoto's not as much as
Not there yet.
As much as I like Nakamoto, it's not there yet, right? But yeah, it's just sort of a little pipsqueak company worth $1 billion. But basically, imagine you get this debt, this piece of paper. You know that you're going to get your money back in 5 years. Why? Because MicroStrategy is not going to go bankrupt, and it's rated, right? So now you have the terms of the bond, right? And you're going to get your money back, right, at a fixed rate. You're getting a minimum guaranteed rate that you're getting your money back. Even if Bitcoin pukes, you're getting your money back, okay? And if Bitcoin does really well, you're participating on the upside, right? You might get 12% return, 13%. You're not getting 200% return, right? But you're getting it's meant for a fixed income investor. A fixed income investor does not expect to double their money, right? They don't, or triple their money. But if they can get, a double-digit return, wow, that's amazing.
Amazing,
That's
yeah.
amazing. These guys,
Most fixed income is under 7%.
yeah, I mean,
I have a friend that does fixed income wealth management.
So
He's like,
I
target
think-
5.
yeah, target 5.
Target
So look,
5, yeah.
Look,
That was years ago. But yeah.
I think this is the perfect structure for no. Could strategy do this? Yeah, they could do it like now. They could do it 2 weeks from today, right? Somebody's going to do this. I think strategy could do this. 21 could do this. Any number of companies could implement this. And let me tell you, from a bond perspective, a fixed income buyer, it's fantastic, right? They'll love this. All right, let's continue.
Yeah, so anyways,
2027.
there's I think we could just generally say that if we look at this timeline,
Yeah.
sort of like over the next 5 years,
Mhm.
it can go from government adoption to mainstream acceptance.
Yeah.
Reaching like $1 trillion very quickly.
It could get to $1 trillion within 5 years, right? Of Bitbonds. This is like such a great structure. I mean, when I saw this for the first time, I was like, oh my God, this is the structure that we all need. And Dark Side saw it immediately. Marilyn Huddle saw it immediately. So we're seeing this because we're ex-bond guys.
Because they're bond guys. Yeah.
We're bond guys. So we were looking at this stuff and we're like, yeah, this is exactly what you want. Now, is perpetual preferreds? Nah, not exactly. It's kind of like that Hertz commercial where they were like, if you take Hertz, you get a reservation at Hertz. He goes, well, not exactly. It's like, do they have the car waiting for you? Well, not exactly. It's like, they offer you your money back if the car's not there? Not exactly. Well, and then the tagline is Hertz. Exactly. This is exactly what a bond market investor wants to hear. Exactly. All right.
So for comparison, high yield bonds took 15 years to reach $1 trillion, but ETFs took 13. Bitbonds could do it in 5. So Bitbonds perform financial alchemy. They transform the risks of Bitcoin into manageable components. Volatility risk becomes option value. Investors can choose to accept or decline. Custody risk shifts from individual investors to professional custodians with institutional grade security. Regulatory risk gets absorbed by regulatory issuers who navigate compliance requirements. Career risk disappears for the managers through traditional packaging that fits existing investment mandates. So this transformation of risk could unlock trillions in conservative capital that can't touch Bitcoin directly. Once Bitbonds launch, competition will drive rapid evolution. Issuers will compete on rates and participation percentages. Innovation will accelerate, and first movers will capture premium pricing and set market standards. The jurisdiction that creates the regulatory framework first gains massive competitive advantage, becoming the first global hub for Bitbond issuance and trading. Bitbonds remain largely theoretical, but the concept is too powerful to ignore. They could transform Bitcoin from a speculative asset into the foundation of a new fixed income market, the bridge between Bitcoin and the 130 trillion global bond market. The CMO revolution transformed housing finance. The high yield bond revolution enabled modern private equity. The ETF revolution democratized investing. The Bitbond revolution, if it happens, could be bigger than all of them.
All right. So I just wanted to let you know, I started these videos a couple of years ago, and I talked about the upcoming Bitcoin ETF. At that point, that was also theoretical. At that point, we didn't know if it was going to get approved. I had a hunch that it would because I had experience with BlackRock, so I was like, yeah, these guys are going to get it. But Bitbonds are also a theoretical thing, but they're exactly the right structure, and these financial innovations can be really powerful. The CMO was the innovation that drove a wave of innovation after that, right? But it changed America. It changed how the mortgage lending business was done, and the securitization of mortgages was really important. So right now we have this mountain of debt. The bond market is $130 trillion worldwide, right? Now, if you can take that $130 trillion of bonds and turn them into Bitbonds, a meaningful part of that, meaningful, a percentage, 1%, $1.3 trillion, right? If that becomes Bitbonds, watch out below, man. This is going to change the world. So extremely bullish on Bitbonds. And buy our book. Now, as Michael Lewis said in the movie Money Never Sleeps, the sequel to Bitcoin, he goes, "You guys are all basically." He's talking to a group of younger people, and he's coming out of jail, and he goes, "You guys are all pretty much fucked." And that's his opening line. Then he goes on to tell them about how the housing market is just this Ponzi scheme and all this stuff. And he goes, "How do we fix it? 3 words: buy my book." 3 words. So please buy the book.
This book's going to help you orange pill people like never before. That's my experience so far.
Yeah. So buy the book. Available on Amazon. How is the audiobook? Is that coming along?
I haven't heard anything today, so hopefully this week. It's been submitted.
Okay, it's been submitted, so audiobook pretty soon. But you can obviously, you can get it if you're like super budget conscious. You can find these videos, and you can get some of the content on these videos, or just support us and buy the audiobook. And orange pill your friends. Thanks, guys.
See ya.